Is the housing market really as bad as the media is telling you? I don't think so. I have some interesting numbers for you to look at. Hi everyone, Tom Mason with Coldwell Banker Realty. Over the past few months we've heard about how the housing market in 2023 is going to be terrible. It's not going to recover until 2024 or 2025. Well, I think that's Well, I don't think that's the case, and I have some numbers to show you today that can prove that. Like the rest of the country, Phoenix saw a tremendous increase in housing prices over the last few years, and when the mortgage interest rates went up, it made it unreachable for normal people to own a home. But there are some interesting things going on in the marketplace right now, and you probably know about them, but you don't know why they're important. A lot of people focus on the Fed raising the prime lending rate or the banking rate, but that really has nothing to do in the short term with mortgage interest rates. What is more important on mortgage interest rates is the rate of inflation, and we know that that's coming down. Here's a very simple graph showing year-over-year inflation and why that's important. We know that the housing market in 2022 was impacted by mortgage interest rates, and as inflation grew through 2021 and started staying high in 2022, eventually we got to a point in November where these lines began to cross. In other words, the year-over-year inflation started to decline. At this time, we saw a change in one of the most important variables in the housing market, and that is the 10-year Treasury note. This is a live look at the 10-year Treasury note today, January 18, 2023. Yesterday, this was at 3.505. So you see a significant drop already today, but we want to look back also and see what it looked like just a few months ago. This gives us a better idea of where we were and where we're going. Back in October, we were at 4.24%. Now, if you added 3% to that, you'd see that we were right about 7.37%, which means the secondary mortgage industry added more than 3% to the 10-year Treasury in order to come to the mortgage interest rates. Now, normally, historically, we should see that at about 2.25%, but they're adding 3% because they need to make up for inflation. Inflation bites into their profit margin, so the secondary mortgage industry added that 3%. Now, through November, right after we get the Fed reading, we see that the Fed decided they only wanted to go 50 basis points instead of 75, and there was a significant drop in the mortgage interest rate. And again in December, we see that same trending movement along this chart line. Now, we did get a little bump up in January. This some people attribute to the Eurobank raising their 10-year Treasury return, and so European investors might stick closer to Europe by buying their bonds instead. The Treasury raised ours in order to attract those investors back, but we see this continual decline all the way to today, where we're at 3.38%. Now, if you take a look at this and you add 3% to that, that would put us at 6.3%, about 6.4. We're actually at 6.04% mortgage interest rates today. So the secondary market has reduced the amount of vigorish or interest that they've added to this baseline number. But if they went back to their historic addition of 2.25%, then we'd actually be closer to 5.63%. We're still at 6.04. But tomorrow, if this number sticks today, we'll be below 6% mortgage interest rates by tomorrow. It usually takes a day for the adjustment to occur. So, hope and pray that this stays at the 3.3 level. If it does, we'll be in the 5s by January 19th. And that's good for the marketplace. And that's good for you if you're a buyer, and even if you're a seller, because now you have a lower interest rate to look at. And if you buy down that rate, it's even better for you. So now instead of buying down from the 7s, you'll be buying down from, say, 5.9%. 2% off that, you'll be at 3.9% with your buy down. While the interest rates are very important, there's also supply and demand. So what's going on in Phoenix? Right now in Phoenix, we're about 100,000 homes short of what we need. Every year we have 80 to 100,000 people moving to Maricopa County. So in the next year, we need more homes. But new home builders have stopped pulling permits. In other words, they don't think they're going to make their money back. Except for one builder I talked to. If you want to know who that builder is, who's actually pulling 150% more permits than they did last year, give me a call and I'll tell you who that is. But with a reduced number of permits, that constrains supply even more. less supply,
more demand.
and what happens to prices in that kind of marketplace? Think of eggs today. There's less supply, same amount of demand. Where are eggs at? I'm a subscriber to the Cromford Report. Some of the brightest minds who have been studying Phoenix and the market here in Arizona for many years. And I wanted to show you exactly what's going on or what went on in November of 2022. Let's look back at the beginning of November, and with the Cromford Report, generally think about it this way. If you see a number at or around 100, think of that as a balanced market. So equal buyer, equal seller. But if you see it drop below, and the farther it drops, the better it is for buyers. Down here is a buyer's market. Above this, above 100, is a seller's market. We can see from November last month, you see the Cromford Index for last month. For Fountain Hills, which is one of the more expensive areas of the Phoenix area, or the Arizona area, went from 162 to 147. So we saw a significant drop. Even though it's a strong seller's market, still a significant drop month over month. And we really only see like 3 areas that are significantly above that 100 line. Cave Creek is right about 100. Phoenix is pretty close to that. But there were only 3 areas in November, on November 3rd, that were above, significantly above 100. Meanwhile, look at all these down below. These are all buyer's markets in here. Slow housing market. Let's go to the end of November and take a look and see if there's any change. Well, we do see there are still only 3 that are above that 100 mark. We do see some improvement in a couple, but again, these are all buyer's markets down here. Now let's jump to January. Let's jump to this month. What do we see now? Instead of 3 at the top, we see at least 7 that are entering into sellers markets again. And in the middle we have 3 and maybe 4. And then below we only have a few that are now buyers markets. So we're seeing an increase in advantage to sellers because they've reduced the amount of inventory that's going to be on the market through new home builders and through resale sellers, people who are going to put their houses on the market. We still have demand out there. Demand is not really that strong. But when supply is equally not as strong, then you have sellers who are at an advantage. And in these areas, these are the only areas where the buyers are now at advantage. And this is also mostly due to the drop in mortgage interest rates by about a point from October of 2022 to January of 2023. If you're looking for these areas in the West Valley, certainly give me a call. I'll give you a hand with finding the right place. There's still concessions being given by sellers. There are still low prices out there. There's still some prices coming down, but I think we're starting to see a stabilization of the marketplace where you're going to experience fewer homes that are going to reduce their price. I mentioned before that I hadn't posted in a while because I had to take care of some personal business back in Pittsburgh, Pennsylvania, my hometown. My middle brother had died, and so we had to take care of the estate. So, Scotty, play us out.
I've been down, take my word. I've been around, yeah. I ain't asking for much. I said no, take me downtown. I'm just looking for some touch. We've been raving, we've been riding, we've been up and down, down, up, any way you want it, rolling. Yeah, yeah, yeah. You got me doing what you want me, baby, what you want me to do. Take it away.